As a finance professional in a disrupted business landscape, what does it take to be in demand? What does it take to attract great paying international roles? If you're an ICANN member, it'll just take one exam. That's all it takes to complete the globally recognized SEMA professional qualification and the internationally respected CGMA designation. As a SEMA member and a CGMA designation holder, employers will look at you as a finance professional, constantly acquiring new skills to add value to the business. That's why they'll be willing to pay premium to hire and retain you. If you have 5 years of relevant experience and are an ICANN member, you can directly sit for the final exam of the SEMA Professional Qualification, the Strategic Case Study exam. Start studying the SEMA Professional Qualification. Prepare to make an impact.
Okay, good evening, ladies and gentlemen. Good evening, my amiable audience. This is Icon on Air, and it's the fourth day in the month of April 2024. I guess it's the first Icon on Air program in the month of April, so we're happy to be here today. And it's something that everyone can resonate with. And all of us we're privileged to see the letter dated 28th March 2024, and it was signed by the CBN governor, where there was a circular on all commercial, merchants, and non-interest banks, and also the promoters of proposed banks. So this letter was actually to review the minimum capital requirements for the commercial, the merchants, and the non-interest banks in Nigeria. So today we're going to be delving into that serious matter. It's serious matter because a lot of agitation right there in the markets. Everywhere you go, if you enter the bank, you see a lot of people on the queue. Everyone is just agitated about what is going to become of the banks. So we all know what the banking sector recapitalization program is. And if you do not know what it is about, Icon on Air is bringing that to your doorstep today. And that is about the regulatory initiative of the Central Bank of Nigeria, where they require banks to increase their minimum paid in common equity capital to a specified amount in accordance to the license category and the authorization within a specified period. So today, the topic is bank recapitalization, the lessons from the past and the prospects from the future. I recall when this happened years back, we all didn't actually know how this would end up. We had a lot of banks closed down. They were bought over and a lot of things happened. A lot of restructuring happened. But now we want to educate ourselves on what this is about. And we have a special person to do this in person of Professor Uche Joseph Waleke, FCA. He's the Director, Institute of Capital Market Studies at the Nasarawa State University, KEFI. But we'd like to go on a commercial break. And when we come back, I'm going to tell you all about Professor Uche Joseph Waleke, FCA, and the topic of today. We'll go on a commercial and we'll be right back. And welcome again.
As a finance professional in a disrupted business landscape, what does it take to be in demand? What does it take to attract great paying international roles? If you're an ICANN member, it'll just take one exam. That's all it takes to complete the globally recognized SEMA professional qualification and the internationally respected CGMA designation. As a SEMA member and a CGMA designation holder, employers will look at you as a finance professional, constantly acquiring new skills to add value to the business. That's why they'll be willing to pay premium to hire and retain you. If you have 5 years of relevant experience and are an ICANN member, you can directly sit for the final exam of the SEMA Professional Qualification, the Strategic Case Study exam. Start studying the SEMA Professional Qualification. Prepare to make an impact.
You're welcome back to Icon on Air. And my name remains Fumi Olani. And I'm happy to be in your midst today, bringing you this very, very topical issue, things that resonate around our financial service, how we do things, and how we bank. We all have money in the bank, and we're interested in how the banks are going to hold our money in custody. So this evening, we're going to be discussing the very topic of bank recapitalization, the lessons from the past, and prospects from the future. And before we went on a break, I mentioned we have Professor Uche Joseph Waleke, FCA. He's the Director, Institute of Capital Market Studies, Nasarawa State University, KEFI. And before then, he was the HOD of Securities and Investment Department and of the same university. And we're very happy to have you in the studio today. You're welcome, Prof.
Thanks so much, Fumi. It's indeed my pleasure.
Thank you. We are quite honored to have you here today. So, Prof, everyone knows about this topic. Perhaps even the formal sector, informal sector, we all know what is going to happen because CBN just came up with the rules. Yes, it's a wake-up call for banks because they are keeping people's assets in custody. So today we want to discuss it. We want our people to know about it. And when you're trying to fix a national economy, and concepts and also strategies, you will require such a recapitalization. There will be a restructuring, there will be reconstruction, recalibration, in any way that you can call it. And this will be necessary depending on how wounded or how derailed an economy is. And even across the world, we all know what is going on. Inflation is right there. You know what is going on with our Forex. You know everything about it. So right now, we want to talk about it. Let's discuss this very, very interesting topic. And because we have global audience here and they also have accounts in all these banks that we're talking about now. And it's good that CBN has come up with this. But, Prof, in general terms, how can you help us or enlighten our audience, or how sick do you think the Nigerian economy is today?
Once again, thanks for me. I'm indeed delighted to be your guest, your first guest in the month of April on this Icon on Air program. Talking about how sick the economy is. The best way to answer that question is to look at it from the macroeconomic indicators. What are these indicators? You take inflation, for example. The last inflation rate we have, that of last month, inflation came in at 31.7%. And that's been talking about the average level of inflation. Food inflation is as high as close to 38%. Okay, so we know that the pressure is actually on food. And because of that, the economy is going through, or Nigerians are going through, if you like, cost of living crisis. Okay, then there is also the exchange rate. Of course, part of why inflation is as high as it is today is the exchange rate pass-through. Okay, we know that in recent times, the value of the naira has plummeted. Exchange rate has gone from as low as 700 naira to the dollar to as much as in fact at some point it was 1,800. The good news, of course, is that it has come down to about 1,300 naira, to the dollar. Unemployment is also high. The last number from the National Bureau of Statistics talks about 5% using their new methodology. So we have high unemployment rate, we have high inflation rate, high exchange rate, and also low or tepid GDP growth rate. GDP growth rate last year came in at 2.74%. In 2022, the year before then, it was 3.51. In 2021, it was 3.54. So you notice that over the last 3 years, GDP has been on the decline on an annual basis. So essentially, one can say that these are the indices you can use to, talk about the health of the economy. The only, if you like, where you have the, if you like, some light is coming from the financial sector, the stock market, for example, and the financial services sector, where banks dominate. That's the only place you could say we have one is saying some, green light, the others are more or less red.
Hmm. Prof, I like the calmness in your voice and the calmness at which you bring this topic to us. But the word recapitalization, it actually sounds very scary to many because it seemed like what happened in the past is coming back to haunt a lot of people. So, and it comes with that bad omen. What exactly is recapitalization, and which sector is it applicable to?
Well, we're all professional accountants. I'm sure we understand what it means by recapitalization. What is capital? Capital is owner's equity. What uh, belongs to the owners after you have taken out liabilities. And in a sense, we often say owner's equity is the owner's share in the business. We know businesses are legal entities. Okay, so recapitalization is simply about shoring up your capital. Um, and in this context, the sector we're talking about is the banking sector. This is not the first time it's happening. As far back as 1979, if you permit some bit of history, in 1979, the banks then were also required to recapitalize. Commercial banks at the time, had a target of 600,000, just 600,000 naira in 1979. For merchant banks, it was 2 million. Okay. Then we had in 2000, there was also recapitalization when banks, both commercial and merchants, were required to, do as much as 1 billion. That was the minimum capital at the time. And then on and on until 2001, when the merchant banks, so for commercial banks in 2004, the central bank also, came up with another program requiring commercial banks to increase from plus. We're all familiar with the 2005 case when we had a lot of banks, 89 of them, many of them were weak. And the recapitalization at that time was meant to, strengthen the banks and take out a lot of the banks that were weak. So at the end of the day, 25 banks emerged. Now, the latest we have on the capitalization was in 2010. In 2010, when the central bank also came up with a risk-based approach to capital, minimum capital, in the sense that central bank came up with a tiered structure such that commercial banks with international license, central bank increased their minimum capital to 50 billion, from 25 billion to 50 billion. For national banks, central bank retained it at 25 billion. For regional banks, 10 billion. And since then, too, we've had non-interest banks, the likes of JICE, the likes of Lotus and Taj. Central bank also had targets for them, 10 billion for JICE Bank and 5 billion for the other two. So essentially, it's about shoring up the capital base. And if you can check, I said in 1979, the minimum capital was just 600,000. Can you imagine 600,000? Today we are talking about 500,000, 500 billion from 600,000. So what does that tell you? It tells you that it shows you the effect of depreciation of the naira over time. In 1979, the exchange rate was around $1 to one naira. One naira was even stronger. Today, we know what the story is, and that's why the major driver behind this recapitalization is naira depreciation. The fact that naira has lost value over the years.
Wow. Okay. I still feel that a lot of people are agitated, right? And since the announcement of the bank recapitalization last week, there has been panic. Even going to the bank, you see people on the queue. They don't want their money to perish with the banks that will likely go down because the perception is that there will be job losses and some Nigerian banks would go into extinction, like we experienced in the 2000s. So some depositors also may lose their savings. I recall in the past how it happened to old people. I know a few of people of business owners that the money just went down the drain. As an authority in this field, is the panic or fear amongst Nigerians, can you say it is justifiable?
No, I don't think so. As a matter of fact, one of the main objectives of the exercise or the program is even to make banks more resilient, is to make the banks stronger. Recall initially when I was talking about the economy, the general health of the economy, I singled out the banking sector. I also singled out the stock market, the financial sector. Okay. The central bank, tells us, with data that the banking system is sound, is safe, is secure, is stable. Okay. Using financial soundness indicators, whether it is the capital adequacy ratio for banks, central bank says all our banks have capital adequacy ratio that is in the region of between 10 and 15%, which is the band that central bank has. As a matter of fact, on the average, is around 13.7%. For non-performing loans, central bank has a limit of 5%. Banks carry on the average 4.7 or 4.8%, which is also below the limit. And for liquidity ratio, central bank has a limit of 30%. But a lot of banks, have more than that. The average in the industry is 40%, much more than the minimum. So, in terms of the prudential ratios, our banks are stable, safe, and sound. The major reason the central bank is doing this is to put the banks in a stronger position to help contribute to achieving the $1 trillion economy that the government is talking about. So, in a sense, is to make deposits safe. So, stronger banks will mean that deposits will be safer. As a depositor can sleep with two eyes closed. So the fears are not. I don't think they are founded. Even on the part of investors, well, temporarily, yes, we expect that share prices will come down because as banks go to raise funds, as they go to issue shares, particularly rights issue, when you do a rights issue, you are doing it at a price below the market price. So usually after rights issues, you find prices of company stocks coming down. And that's also partly why you find that today banking stocks are beginning to lose value. So that is bound to happen because when you recapitalize, you bring in more capital, earnings per share will drop because you have a larger base, dividend per share also drops. So when these fundamentals of companies are dropping, what you should expect is that the valuation of the share too will drop. So on the part of investors, that is what you are likely to get in the short term. All right. But in the medium to long term, by the time these banks are able to get this additional capital and they expand with it, we also expect that earnings should grow. So I want to tell depositors that nothing to worry. Central bank is there, the NDIC is also there, and what is important at the end of the day, deposits are secure. Our banks are stronger and in a position again to compete internationally, given the erosion of capital by the depreciation that has happened over the time.
All right. So, Uche Joseph Walike has assured us that we should just go to bed and then everything will be all right because it's on the watch and care. And it's in our own interest. So today we're still discussing bank recapitalization, the lessons from the past and the prospect from the future. So I want to encourage our audience. Please feel free to share your questions. If you have any questions pertaining or with regards to bank recapitalization, or you just want to share an idea, please feel free to send your questions across. And Professor Uche will be very much available to take everything that you have in mind to tell us. So, Prof, considering the devaluation of the Naira by the government and also the current inflation figures, I know you mentioned the inflation figures and the irregularities in the rate, but some concerned technocrats, they see the exclusion of retained earnings as insensitive by CBN and government. What is your position on the exclusion of retained earnings?
This has been a contentious one. If you look at what happened in 2005, central bank allowed retained earnings. The Basel III Basel III Accord. Basel III is an accord, of course, by a group of central bank governors, the Bank for International Settlement, defines Tier 1 capital as share capital plus retained earnings. Of course, we know, we are professional accountants, we know retained earnings are revenue reserves. Share capital plus retained earnings plus reserves, capital reserves, make up shareholders' funds. So in 2005, the central bank defined the capital as paid up capital plus reserves. Then under paid up capital, the central bank at the time defined paid up capital as share capital plus non-redeemable preference shares. Okay. Now remember, preference shares are hybrid securities. So at that time, central bank allowed preference shares, non-redeemable or irredeemable preference shares, plus paid up share capital as the paid up capital. And then for reserves, central bank said all reserves, excluding revaluation reserves. So central bank didn't allow a situation in which banks would revalue assets and then credit that. But what is important to note here is that in 2005, shareholders' funds was allowed. But now central bank is not allowing retained earnings. It's simply allowing share capital plus share premium. And we know share premium is the excess of the market price over the par value of a share. So what the central bank is trying to do, the way I understand it, central bank is only interested in fresh capital, okay? Whatever that is backed by cash, retained earnings, revenue reserves, don't necessarily have to be backed by cash, especially in the case of banks. In the case of banks over the years, a lot of banks have grown revenue reserves that were not backed by cash. If you like, a lot of them were impaired by losses. Now, central bank prudential guideline says if a loan is non-performing, that is interest and principal interest are not coming up to 90 days, that loan is non-performing. Between 90 days and 180 days, okay, it should be regarded as substandard. We know all this. Between 180 and 360 days, doubtful. For substandard, provide 10%. In other words, reduce your income by 10%. For doubtful, by 50%. For principal and interest that have not come for 360 days for 1 year, regard them as lost. So do 100% provision. And what that means is that go and hit your capital, reduce your capital by that by the full size, the full amount of the loan. Now, in 2020, central bank gave forbearance, asked banks to go and renegotiate with their debtors. So you now find that a lot of banks have revenue reserves that ordinarily are impaired in the sense that losses should have been used to reduce them, but central bank allowed them to carry them. Okay, so that's partly why central bank is saying for the purpose of this recapitalization, we won't allow retained earnings, because the quality of retained earnings is you can't speak for it as a result of impairment. Okay, so but my view, my take on it is this: if the central bank may allow retained earnings on the condition that those retained earnings are unimpaired by losses. So it is possible to say share capital plus retained earnings unimpaired by losses. So the proportion that's impaired by losses must be taken off, okay, to allow banks to add the proportion that is unimpaired. But again, if that central bank also does that, it will mean that some of the banks may not even need to raise fresh capital, because a number of our banks today, if you add their retained earnings plus their share capital, you have in excess of 500 billion. But the way it is now, virtually all the banks will be going to raise money. Zenith Bank, for example, has 270 billion share capital. Okay, so Zenith Bank will be looking for about 229 billion, excluding the retained earnings. Access Bank has about 251 billion and will be looking for 248 billion. So a number of them will be going to the market to raise funds. And central bank has given 3 options. First, you can do offer for subscription, go to stock market and issue shares. Or you can also do rights issue, again through the stock market. Or you do private placement. That one doesn't go to the stock market. You identify high net worth individuals. Or you can do, you can go into mergers and acquisition. Okay. The third option, of course, has to do with downgrades when you're unable to meet up, you can downgrade. So on the issue of retained earnings, my summary of what I'm saying is that central bank has justification for excluding retained earnings, but given the the current pushback, okay, it does appear that banks are saying, let us have our retained earnings included. But for central bank to do that, all the impaired portion, must be should be excluded.
That they can cope with. I mean, this is what we can do. We can afford it. So there's no problem. Let our customers go to rest. For example, I was just having a conversation with Stambik yesterday, and they said, "Don't worry, it's just it's a bed of roses. We're okay." And I said, "Okay, bring it on." All right. I would like to recognize some of our audience here. Thank you so much, Onyema Emmanuel from. You're just saying thank you. It's a new dawn. Yes, we know it's a new dawn with the accounting profession with ICANN. Sonny Abdulakim, thank you, is streaming in from Dala Inland, Dryport, Kano. Thank you so much, Sonny. And Lydia Tolulokwe Adenaike, thank you so much for logging in from Ogun State. We see Luther Agobil, we see Pete Remy Uzogo, and Solomon Uziaji. I say thank you so much. And my dear Akiwumi Tosi, we see you. Thank you very much for being there for us. Oladipupo, we see you. Thank you so much. Kamal Shitu, Bashir Ahmed from Kano City. Thank you so much for joining. From Abuja, we have Lillian Mbono and we have Marizu Godwin saying hello. So we have a couple of our members and also our audience that want to participate in this program. And they're saying hello to you, Prof. And they will bring their questions very as soon as possible for you to help them. We have to delve into these matters as real as it is. So, Prof, considering the current level of insecurity and corruption perception that we have today, it's believed that these things have been going from one level to another in a bad light, right? But it has generally been felt that institutional investors, that they may not want to they want to play pivotal roles in providing the requisite capital infusion after the bank recapitalization. What is your, I would say, just give us your unbiased opinion about this for the institutional investors? Yes.
Yeah. Who are the institutional investors in the market? I told you central bank has met the first option, that of the stock market. Who are the institutional investors? Institutional investors are pension funds, the mutual funds, insurance companies. These are institutional investors, and I think they represent a very active captive market, for the shares of the banks. And what is important is to ascertain that the banks in question have good fundamentals, and I'm pretty sure the institutional investors will, take up any shares that are out there, are issued by these companies. So institutional investors, in my view, will be responding. We're also expecting that foreign investors would probably show interest. One of the concerns around this recapitalization, has to do with the fact that whether the stock market even has the capacity to absorb, or to be able to raise the kind of money we are looking at here. I read a report by Augusto and Company, the rating firm, talking about an amount in the region of 4 trillion. So with the stock market be able to, assuming all the banks say, okay, let's go and raise it from the market. Okay. So these are some of the concerns. Again, given the fact that we have limited in terms of retail investor base, is not very strong. Institutional investors, have mentioned them. Pension funds today are, I think, close to 20 trillion. But even that, there is only a limit to what you can do with them. There's only a limit that can be invested, in the stock market. But I think that it will open up in a number of opportunities. As I said, new retail investors may want to come in. The same with foreign investors. In 2005, the market was able to generate up to 450 billion naira. A number of companies, did IPOs, and that kind of funds came in. So we also expect that this time around, that with new retail investors as well as new foreign investors, the bank should be able to, generate that. So I think that's nothing to fear. Institutional investors, would certainly participate.
Okay, Prof, let's talk about BDC, Bureau de Change. As a professor of finance and capital markets, within the bank recapitalization of a 24-month compliance window commencing from April 1st, 2024. And that would end 31st, 2026, 1st of March 2026. What should we expect on the practice and the relevance of the BDCs in Nigeria when you want to compare them with the other countries or jurisdictions that have been doing so?
First, on the time frame, I think 2 years is sufficient for the banks to shore up their capital base. But there is also this 30-day deadline given to banks to submit their implementation, program. That to me is inadequate. The central bank should look into it, with a view to extending it. Before a bank can adjust its capital, the bank will need to get the consent of the shareholders. That's what is required in the Companies and Other Matters Act of 2020. And for you to do that, you must convene an annual general meeting or an emergency extraordinary meeting. And such would require at least 21 days notice. So that's why I said the 30-day deadline is rather short. Central bank should consider extending that. On the part of BDCs, I think the same measure, central bank should also be looking in that direction, the direction of also using regulatory measure to ensure that we have reduced number of BDCs. Okay, at some point you recall, we had close to 6,000 BDCs, and only recently, one of the things the central bank did was to withdraw the license of over 4,000 BDCs. Okay, but we still have a huge number even after that in excess of 1,000. In other climes, BDCs are not as large as we have in Nigeria. So for the number to come down to a manageable level that the central bank can deal with, I think there is also the need to extend the capitalization program to the BDCs. That's where they will play a more sale of forex to BDCs. The central bank needs to deal with a manageable number that they can monitor.
Yeah. Fair enough. Thank you so much. So it's still Icon on Air today, the 4th day of the month of April 2024, and we've been discussing bank recapitalization with Professor Uche Uwaleke. We'd like to go on a commercial break, and when we come back, get your questions together, and we'll take all of those questions that you have with Prof in the house to put some justice or to do justice to the questions. So we'll be right back after the break.
As a finance professional in a disrupted business landscape, what does it take to be in demand? What does it take to attract great paying international roles? If you're an ICANN member, it'll just take one exam. That's all it takes to complete the globally recognized CIMA professional qualification and the internationally respected CGMA designation. As a CIMA member and a CGMA designation holder, employers will look at you as a finance professional, constantly acquiring new skills to add value to the business. That's why they'll be willing to pay premium to hire and retain you. If you have 5 years of relevant experience and are an ICANN member, you can directly sit for the final exam of the CIMA Professional Qualification, the Strategic Case Study exam. Start studying the CIMA Professional Qualification. Prepare to make an impact.
You're welcome back to Icon on Air. We're discussing bank recapitalization. And, just to give you, to shed more light on what this is all about for, in the interest of those that do not know. So, in Section 9 of the Banks and Other Financial Institution Act, the CBN actually announced that there's going to be a review of the minimum capital requirement. So that is what we are discussing here in the studio. And Professor Uche Waleke is providing insight into this topical matter, and we will take some questions from our audience. But once again, Professor Waleke, you're welcome back into the studio.
Yeah, thanks so much. Thanks so much for me.
Okay, so Prof, before I take the audience question, on Tuesday, the 26th of March, 2024, the CBN actually raised the monetary policy rate by 200 basis points from, it was 22.75% and it was raised to 24.75%. And in about 48 hours, the CBN announced the new guidelines on its recapitalization policy for banks in the country. What will be the effect of CBN's action on inflation, on survival of organizations, even the value of the Naira and the future of SMEs in particular?
Yeah, thanks. First is the MPR hike, current monetary policy stance of the central bank. That's meant to be temporary. That's meant to be short term, because the central bank expects that before December, it should be able to moderate inflation to 21.4%. That's the target they have for this year. So it's temporary, but this program is you can see it as a medium-term program, a 2-year program within which they are expected to, recapitalize. So there is a mismatch when you compare the two. But of course, the concerns are genuine. People have said why the central bank, on the one hand, is aggressively tightening, monetary policy, using cash reserve requirements as high as 45%. Of course, we know what that means. For each 1 Naira deposit, the bank sterilizes, 45 kobo. That is not remunerated. So that limits the ability of banks to, make credit. So the concerns are actually founded. You're constraining the banks by so doing, and then on the other hand, you're also saying they must recapitalize, and even in doing so, you're excluding retained earnings. Okay, another constraint. So, but what I've just said here is that we expect that with time, central banks should, would begin to relax the stance, the monetary policy stance. The other thing to also do with inflation, people have also said that when you ask banks to go and raise as much as 4 trillion in capital, I've just told you a study, put it around that region, 4 trillion. The effect on loan would also be, you're saying that the banks now will have the capacity to do as much as 40 trillion Naira loan, okay, in order to maintain their capital adequacy ratio. If capital adequacy ratio is 10%, okay, CAR is the ratio of capital over risk-weighted assets, over loans, which are risk-weighted assets. So if the capital is 4 trillion, it means that the loan, the capacity of the banks, the loans they are able to create will be 10 times that. That's 40 trillion, because 4 over 40 is 10%. So for them to maintain 10% capital adequacy ratio, they should be able to create as much as 40 trillion. So questions have been asked. Does the economy have the capacity to absorb this kind of liquidity, this kind of money, in the system? So why would the central bank be doing that on the one hand? On the other hand, it's also trying to mop up and constrain, liquidity. So these are some of the concerns. But again, as I've said, one is supposed to be short term, the other is supposed to be, a longer term measure. But overall, I think the cash reserve requirement of 45% is too high. Central bank should consider reducing it. It's one of the highest even in the world. Sub-Saharan Africa is clearly the highest. you hardly find countries that where reserve requirements are as high as 45%. All right. So that's my take on it. Central bank should try to reduce the cash reserve requirement for bank for this, at least to help the implementation of this program. Yeah.
Okay, nice one. Thank you very much, Prof. So I have a question from Fagwala Temi Tokweabini. But before then, I'm going to read a comment from him, congratulating our newest first among the equal 60th president of the ICANN. And is praying that he ushers developmental stride to ICANN and ICANN family at large. You say, congratulations, Chief DCS Alaribe, FCA. So his question is, what measure is CBN putting in place to ensure that the illicit fund flow did not mix up with other means of funding ahead of recapitalization race for the money deposit banks? Prof, over to you, sir.
Let me join you to congratulate our president-elect, Chief DC Alaribe, 60th president of the Institute. As a matter of fact, he spoke to me a while ago, so I joined others in congratulating him. Now, on the issue of illicit funds, that's a very genuine concern, especially when the central bank has also made the issue of private placement one of the options. Banks are free to identify high net worth individuals and collect monies from them. So that's private placement. Of course, that carries the risk of illicit fund flow and money laundering. But again, if you read that central bank circular, it talks about measures they have put in place, working in conjunction with the EFCC, to ensure that that doesn't happen. Asking the banks to scale up or step up their acts with respect to KYC, with respect to due diligence, and with also respect to monitoring suspicious financial transactions. So I think the central bank, has put in place measures to ensure that that doesn't happen.
Not in support of cost of capitalization, which is similar to what you have said, Prof. God help Nigeria. Just any way to stabilize the economy. It was actually in their need of anything just to economically stabilize the country. So, Prof, as a Nigerian living in Nigeria, and actually, we have keenly watched and we have assessed the Nigerian economy. And I know you have to, because that's what you do every day. What is your personal opinion on the removal of this false subsidy on the price of petroleum products, and also on floating of the naira? And also, what is your perspective of bank recapitalization, and also on federal government planned increase of electricity tariff by over 300%, all within 12 months? What would you like to say, sir?
Okay. Well, a basket of reforms. Even starting with the latest one, it's not planned again. I think they have announced it. Nigerian Electricity Regulatory Commission has announced the increase in electricity tariffs for although graduated. And then, of course, before now we have been battling with the issue of fuel subsidy removal, especially the explicit content of the subsidy. The implicit one is still there. That's talking about the subsidy arising from differentials at the exchange rate. That one is still there, but the explicit one has been removed. And then the issue of unification of exchange rates. Okay, now of course the reforms, particularly the removal of fuel subsidy and the exchange rate unification, at the time they were even before the announcement, my stand on them, I've always supported those reforms because of the anomalies associated with the two, whether it's the case of fuel subsidy or we were spending so much on fuel subsidy, opaque fuel subsidy system, and then multiple exchange rates, encouraging round tripping. Of course, I supported the reforms, but what I didn't, where I differed, is it has to do with the approach. Okay, in my view, those reforms needed to be phased. They were not things that we should have, done all at once, abruptly, the way they were done. The same thing applies to even this issue of electricity tariff. I issued a statement just a while ago to the press, where I said that it's important that the government takes a second look at this. Reforms are meant to be sequenced. You don't bring all of them on the table all at once. Now that the economy is still reeling from the impact of these other two reforms, it's important that this decision, this particular one, is postponed or is deferred, to a time when possibly inflation would have moderated considerably. Today, we are talking about very high inflation rate, and then at the same time, you are removing electricity subsidy. It's going to, worsen the, the situation. There's no doubt about it. So I think the subsidy thing should be suspended. Electricity subsidy should be suspended until a more convenient time. We expect that refineries will, start working. So until they start working, until we reduce import of petroleum products, until we stabilize exchange rate considerably, we shouldn't be talking about removing electricity, subsidy. So that's my take on that. But let me also quickly add this. I don't know whether I think I saw somebody asking something, on the chat. You see, it's important for the central bank to ensure that the cost of recapitalization is not borne by the bank customers or depositors. So recapitalization is going to involve costs, okay? And central bank should monitor to ensure that the banks don't shift the costs to customers by way of higher charges, and so on. In 2005, what the central bank did was to provide incentives, was to have a meeting, agree with the Federal Inland Revenue Service to give banks some waivers, capital allowances, waivers, stamp duties, and so on. To also agree with the Securities and Exchange Commission to reduce the cost of, and the Nigerian Stock Exchange at the time, to reduce the cost of coming to issue shares. So I expect the central bank to have an understanding with these stakeholders, the Federal Inland Revenue Service, the Securities and Exchange Commission, the Nigerian Exchange, and the Federal Competition and Consumer Protection Commission. All of them must come together to see that the cost of capitalization is low, and even when it arises, it's not something that the customers of banks, should bear. I'm also aware in 2005, central bank was paying the cost of the parties to, financial advisors that all the banks engage. Central bank even appointed some technical team to assist with the process. So I want to expect the central bank to also do the same, so that the cost is not borne by customers. We don't begin to see higher charges now because banks are being asked to recapitalize.
All right, thank you, sir. Of Abel IICN, FCA, he asked a similar question to what we have talked about, but yeah, we're clear about the retained earnings, and the advice is already there for CBN to consider retained earnings of banks in coming up with the recapitalization. So, Prof, it has actually been suggested that recapitalization of Nigerian banks is actually fundamental to enable us enjoy the good and fair play in the international financial markets, because we were all out. But based on the practical knowledge of the dynamics and intrigues, how have the banks performed in supporting Nigerian multinational businesses, especially those that are involved in export activities?
Yeah, that's even a point in support of the recapitalization. The banks need to be in a position to give those supports, especially the banks with international license, international authorization, that are playing, internationally. They should be able to finance, underwrite credit, finance big ticket projects. If their capital base is small in dollar terms, they won't be able to do that. So one of the motives for this exercise is to make the bank stronger. and for them to be able to, have their feet in the international scene. If you look at our banks today, if you aggregate all our banks, the entire capital base of our banks, it's probably not up to one, two, three banks in South Africa, in dollar terms. So that's part of why the central bank is doing this. And if you also check, since 2005, I just tried to trace the history of capitalization, at the start of this program. Okay, we've had them in succession, but since 2005, okay, we had in 2010, but that was the third thing. We've not had any of such, and naira has been, depreciating at some point too. In some instances, devaluation as a result of government action over the years. So this capitalization is something that is really, really called for. Central bank should also ensure that banks lend more to the real sector. The loan to deposit ratio of 65% should also be skewed in favor of the real sector post recapitalization, so that they can utilize more of the capital that they have to ensure that even the cost of credit is expected to come down if this program is well implemented, because banks have bigger capital, there's more liquidity, so we expect that interest rates should gradually come down.
Okay. All right. Thank you. Yeah. Tom. This question is very important to everyone. There's so much rumor that some transactions within Nigeria are negotiated and insisted in foreign currency, especially dollars. What could be the reason for the insistence on dollar transactions, and what could cause a local currency to be ignored and in favor of the foreign currency, like a dollar, for example?
For me, it's obvious now. It's obvious when you have a very high inflation. You see, even in theory, under the Fisher's model, in theory, inflation is a factor in exchange rate determination. Okay, the ratio of inflation between two countries is a factor. If inflation rate is low in the US and it's high in Nigeria, you should expect that the currency of Nigeria, the domestic currency, will weaken relative to that of the US, because US is having lower inflation rate. So in Nigeria today, inflation rate has eroded the value of the purchasing power of the naira. Okay, the value of the naira is eroded by inflation. So what do people do? Rational economic agents, begin to currency substitute, begin to also look for assets that they can use to store value. They now use dollar as a store of value. So demand for dollar now is being driven by the motive to use as a store of value. So that's why people are demanding dollar. So we expect that inflation rate can come down, the purchasing power of the naira can also improve. Of course, the dollarization, will reduce. Part of why people are holding dollar assets today is also because, as I said, even if you invest, you're investing apart from the stock market today that is returning 39% or 40%. Inflation rate is at 1.7. It's only the stock market today that is giving you rate of return higher than inflation rate. Even if you're buying government treasury bills or you're investing in other asset classes outside of property, okay, the returns are still below inflation rate. And that is why people now investing in dollar, doing cryptocurrency, and all of that dollar denominated assets where they feel they can store value.
Okay. All right. Thank you, Prof. I'm just watching the time. We have so many questions in my head. I've seen a lot of questions from the audience too, but I'm just conscious of time. But what I want to pick out, especially for our diaspora audience, is that, it's believed that in many quarters, multinational corporations are still existing in Nigeria due to the harsh operating climate. They are struggling to exist. And there's also a diaspora remittance that is shrinking by the day, and also CBN's recapitalization. all this indication, will it not affect the economy? And what do you think about the track of prosperity of recovery? I know we're short of time, but just in 1 minute, sir.
Yes, companies are exiting because of harsh economic, harsh business environment, exemplified by difficulty in assessing forex, exemplified by the volatility in the exchange rate. A lot of companies are having difficulty assessing forex to be able to import. Okay, and with the devaluation that happened following the indication of exchange rate, a lot of them lost heavily because they were holding dollar-denominated liabilities. Okay, companies like I'm sure you have read, companies like Cadbury, for example, Nestle, Nigerian breweries, all of them reporting huge exchange rate losses. So that some companies have exited the country, partly on account of this these realities, and that's also why it's important that the government should every effort must be made to stabilize the exchange rate. The central bank has put in a lot of measures in recent times, including clearing backlog of forex forwards, okay, resumption of sales to BDCs, okay, clamp down on Binance. Some of these efforts, have helped to, if you like, calm the market. So today we have seen a semblance of stability in the forex market. I'm sure, going forward with time, the market will stabilize further, and some of these companies would, want to stay rather than exit. But the truth of the matter is that the environment is still very volatile. We use the term VUCA. We say the environment is VUCA. VUCA. VUCA is VUCA. V stands for volatile, U stands for uncertain, C stands for complex, A stands for ambiguous. So we are companies that are operating in a VUCA environment. That's the reality.
All right. 30 seconds. What would be your advice to the president if he calls you to speak to the economic team on the practical benefits of this recapitalization in less than 1 minute, sir?
Oh, yes, of course I would advise that the part of what I've said it earlier, central bank should allow the issue of retained earnings, but let it be unimpaired by losses. It's also important that the central bank should ensure that the cost of recapitalization is not borne by the by customers. Central bank, on the part of cash reserve requirement, central bank should consider reducing the cash reserve requirement from the current 45% and possibly graduate it for banks, for commercial banks, instead of having a uniform rate of 45%. And more importantly, central bank should consult very widely as far as this matter is concerned. I've mentioned some of the people that need to be consulted: the FIRS, SEC, NGS. Central bank should consult them before, at least to be sure that any guideline that they're issuing is quite comprehensive. Okay. Now, I think somebody is asking. You have a lot of questions. I have a lot of questions.
We have a lot of questions, but we can't take any more questions, as it were. I mean, this is an interesting topic, and I see comments from a lot of people advising government on what to do to make Nigeria better. So at this junction, I want to say thank you so much, Professor Uche Waleke. Thank you for speaking to us today. Thank you for letting us know what we should do as government and also as individuals, as the people that own the accounts in the banks that wants to be recapitalized. I want to say thank you very much, and do have yourself a nice evening, sir.
Yeah, thank you. Yeah,
all right,
thank you so much.
Yes. So we'd like to take a couple of questions. A couple of announcements on the program. We have so many questions. It's just thrown in my face right now. The ICANN elects its 60th president, Chief Davidson Alaribe. Want to say congratulations, sir. And also another announcement is the application for fellowship conferment, which ends April 29, 2024. 25 more days to go. So please go register. It is 175,000 naira. So go to the ICANN website and pick and check every information that you need to know concerning yourself, concerning you as a member of the Institute. At this junction, I want to say thank you very much for being part of today's program. My name remains Fumi Olani, and I say thank you and do have a restful evening, everyone.